let's look at succession planning. So if at some point in time you want your farm to go down to your children, and not all of your children want to stay on the farm, which is really common, right? And because farming is tough, you have to be committed to it. And with the acceleration of farmland values, which has been the top number one performing asset class in property over the last 10 years, by the way, in Australia. And when you look at those accelerating values, you go, well, how do we then think about releasing this without creating tax events to our children? Now, if they're all in one trust, really challenging to do. But if you've got, say, $10 million worth of real estate and 5 is in one trust and 5 is in another trust, and you're splitting it between a couple of children, then that can make the division a lot easier. And it doesn't mean that it cannot be used for farming, but perhaps the children are allowed to leverage off farm some of those farming assets to be able to create their own portfolios. Like, it just opens up a world of opportunity. And the challenge is most people think that you can't do it. But the reality is you absolutely 100% can.
Welcome to the Profitable Farmer podcast, where we share stories and tips to help you run a better farming business and create your very own freedom farm. If you're looking to work smarter and not harder in your farm business, welcome. You're in the right place. G'day everyone, I hope this finds you well. To launch straight in, so many farming families that we come into contact with arrive to us, and we're not accountants and we're not experts in this space, but with the wrong structures. When we check them with people who are professional in this space, often the structures we have that support our businesses, our risk management, our wealth creation, our asset protection, are suboptimal and can leave us in a situation where succession becomes complex, wealth is not achieved strategically, and we're exposed to way too many one-off shocks, surprises, and risks than we need to be. Now, often those structures are ones that either our accountant recommends us for the business we have today, but maybe that doesn't support the business that we're away to build. It could be that we've inherited a legacy structure from the prior generation and we've just taken that on and not reviewed it or looked at it intently. And perhaps we're not doing that because we're worried that there are costs, capital gains, stamp duty, and other things that are not worth incurring in order to go about making sure that we've got a business structure that sets us up to succeed and achieve what we need to achieve into the future. I think this is a really important conversation. And to explore this, it gives me great pleasure to introduce to you Andy Fenton. We've come to know Andrew Fenton and Jason Witten over the last couple of years, and they're working actively with us to look at this topic for our members and make sure that we're supporting our members to get the very best structures in place that they need to underpin growth. So Andy Fenton is Director and Principal Advisor at Fenton Financial. They're an incredible firm that specializes in demystifying complex financial concepts, helping people manage risk, and helping people set up strategies to underpin wealth creation and move forward with real strength. They work with really progressive business owners inside agriculture and outside agriculture, some very compelling entrepreneurs and high net worth families in helping them set up family offices that can support true wealth creation through generations. Andy has a really strong background and career in the financial markets, working with Macquarie Bank in Australia and the Bank of New York in London. His qualifications include a Masters of Applied Finance, and he has roles including lecturing part-time with Kaplan Professional for their Masters in Applied Science course. In addition to Fenton Financial, Andy has teamed up with a number of others to create 2 coaching programs. One, the Exit Plan, and the other one is called Positive Mentor. And they help people through those programs make sure they've got their structures right, managing risk well, and really setting up to create wealth. It's great to connect with Andy. It was fantastic to have him present with Jason at our recent client conference and deep dive on this topic. Excited to explore this with you, and especially interested in the conversation we have about what is the optimum structure to support farming families to truly create wealth, manage risk, achieve succession, and structure their business as well. So let's get underway. Andy, great to have you with us on Profitable Farmer. I know the Hawks got over Geelong by 1 point, and you're a proud Hawks supporter. So do I need to ask, how are you?
Mate, I'm very, very happy, as is my little man, 3.5 years of age, and it was his first game. And Dad's a Geelong supporter. And believe it or not, Geelong's my second team, my second favourite team, mostly because we've had incredible clashes over the years. And he was almost converting my little man across to the cat. So I was a little bit worried, and the cat's got up and he's looking sad. And I said, just will it to be the case, mate. Don't worry, we're still in it. Just visualize it and we'll get over the line. And sure enough, he did it, put his head down and 1 point, mate. So 2 of the Fentons were very, very happy. 1, not so much.
Perfect. And no doubt your son is taking full responsibility for the win.
We haven't had a chance to talk too much about it, but I did see him outside this morning with the brown and gold Sharon kicking it about, saying, "Dad, come out and have a kick." So I think that's what I'll be doing after this.
Perfect, mate. It was unreal for us to have you and Jace present at our recent client deep dive around all things risk management, all things tax management, all things business structuring, and all things wealth creation on farm and off farm. So much value to our members. I'm really excited to be able to unpack a little bit of that anyway today. Andy, just to kick us off, would you mind just giving us a bit of your background and through that perhaps your connection to rural and farming?
100%. It's interesting to actually be here, having this conversation. I'm super glad that we are and very grateful to have met you and the team at the Farm Owners, because my background more was sort of investment banking, corporate finance, funds management, both here and offshore. And I say I grew a conscience and I left the world of corporate criminals, as I say, a bit tongue in cheek, and started working with small to medium business owners and started as an advisor to them as a consultant, and then built an advisory firm, a financial advisory firm that specializes in small to medium business owners, and also a consultancy. And took the sort of knowledge that I learned at, working with some of the largest companies on the face of the planet in financial terms, in financial services, and translating some of that into being able to help small to medium business owners, playing at this level. And I met a good mate of mine, Jason Witten, and he's an incredible business owner. And he really wore every belt and blow that a business owner could possibly receive over a professional career. And we ended up running a podcast, Wealth, Wine and Wisdom, which we're taking a little bit of a break from because, well, both of us need to be a bit sober for a little bit longer, but maybe more wisdom, less wine. Together, we started helping small business owners on government grants and all of these various different things that happen in the world of small business, but nobody really knows that they're happening. Like, you've really got to have your finger on the pulse to firstly know that it's happening, and then secondly to dissect it and understand how to use it. And through that relationship and through that podcast, we then built a business called the Freedom Machine and the Exit Plan, whereby we actually teach business owners around Australia the rules of the game. So, what are the rules that we have to play by? And every single one of us need to, but nobody shares the rule book, let's face it. Part of those rules is how to minimize tax, because that's one of our key rules is let's not pay any real tax, or minimize paying real tax and minimize paying dumb tax, which is poor advice or poor decisions based off knowing the rules of the game. And then ultimately, we sort of condense this into a model whereby we teach people the street fighter skills of how to control the cash and not fall victim to the banks and play within the rules, but optimize it, how to minimize your tax, and then ultimately how to generate wealth outside of your business, which is the key thing. One of the things I learned from a good mentor of mine was that business owners get into business for a couple of different reasons, and it's maybe a little bit different in farming. But for many business owners, it's because they're unemployable, which is probably where I sat, or they've got a skill set or a passion that they want to pursue and turn that into a commercial occupation. The problem is that they want freedom and they want the choice to be able to how they spend their time. But the reality is they quite often build these businesses that take freedom away from them and also take time away from them. So it's how do we create freedom in business? Because ultimately, I think that's what business is for. Business is designed in its basic form to produce freedom for the owners of that business. And I think that a lot of people have forgotten that or don't know how to achieve it.
Thanks, Andy, and completely agree. And I think there's a lot of similarities there back into agriculture. You've worked through your time with those small to medium businesses with some real entrepreneurs and some real high net worth individuals and families. And I know also that you've worked with some really large and established farming families. When you think about business structuring and wealth creation, what do you see some of those farming families in particular get wrong?
Well, this has been the interesting part about meeting you guys. And I had a couple of clients within my own world, and they were in the agricultural sector. I'd been in it years ago. I actually used to design products for the agricultural sector, tax effective ones. Now, I wasn't the one who did the bad thing by them, but I helped structure the products up on a technical side. And when one of my clients sort of said, look, we want you to give us advice, and they were in the agricultural sector, I thought, oh, this is going to be interesting because it's unique, right? There are some things that are unique in there. It's got some unique laws in there, and it's got some unique, just by the way that farming is so seasonal in its nature. And so deciding to work with those people, I had to start to dive back into, what is agriculture all about? What are the different rules that people play by? And probably now about 4 or 5 years into it, meeting you guys and really starting to specialize in it, come to a few key kind of conclusions. And I think the first one is, business owners are farmers and farmers are business owners, and there's actually zero difference, right? Ultimately, all of them should be designing their business to achieve freedom. So with that said, there are some unique trends that happen in agriculture. And one of them comes from this idea of succession. Like a lot of farmers, the children of farmers who are the children of farmers and the children of farmers. And what I've learned through working with a number of them is that there's a little bit of this mentality about, okay, well, we're doing it because that's the way that mum and dad did it. And we're dealing with the accountant and the advisors that mum and dad dealt with. And the problem with that is that it's led to some structural inefficiencies and a bit of a lack of equilibrium, I think. And what do I mean by that? It's if your business partners, being accountants, advisors, legal, so on and so forth, if they don't grow with you, then you need to level up and get new ones along the way. And farming has leveled up in an exponential way. And you guys are pivotal to this. You're turning, farming's a science, and you're helping farmers understand that science deeper and deeper and deeper. But just by land values and, the economies of scale, farming has now, surpassed many of the people who support it. And so there's a key few areas that we see, or I see that a lot of farmers are going to get into trouble with if they maintain this view. One's about averaging, right? This idea of averaging over time. We can talk about that in depth if you want to. 2 is risk management. And what most farmers have no idea about when they're structured with land in partnerships, sole traders, sole trading structures, is that they're one accident, one event away from potentially losing everything. And this is a risk that many of them don't even know that they're taking. And it's a structural inefficiency that is there for a reason. And I understand why it exists, but there's not a need for it. So the second one is, I think that firstly, averaging from a tax perspective. Second is structuring. And the third goes to leverage. And they're all kind of interlinked, and they create a whole lot of downstream issues for farmers, which we can go into. But the idea of leveraging, and it's obscene, Hutch. Like, we've seen that many farmers out there who are with a bank, right? They've got maybe $2 million worth of leverage with that bank, and it's secured by property, but it's secured by $10 million or $15 million worth of property. And the third thing is leverage. And Hutch, like, it's insane what we see. And I've got some real ethical issues with some of the things that I see as well. But this is really common. And I could point to about 5 or 6 scenarios right now where they're roughly about this: multiple parcels of land, meaning multiple titles, right? Anywhere between 10 and $20 million worth of land value across all of those titles, and leverage with a bank of maybe $2 million. And the bank has security over everything. Everything. Now, the issue with that is that banks are what we call frenemies, and they're fair weather friends. They will be cheering you on when you are winning, but they will be doubting you and damning you as soon as you have a bad month or a bad season. And there's some real issues with that, because if you have your total asset base, right, if you have your total asset base controlled by a frenemy, then really you are going to fall victim to however they want to play the game with you. And we've seen some really disastrous scenarios. There was a client that we both know more recently that we helped untangle some of the collateral, because they had water rights in there, they had farmland in there, they had a whole lot of things in there, and all they needed was an extra $500,000 to be able to trade through. It's not a really seasonal business. It was in the milk game, so a little bit more consistent. And they needed 500. The bank gave them about 150. Right. And that, in my old world, that's how banks bring you unstuck. Give you enough to be able to make you default on it. And as soon as you default on it, there's clauses that then allow them to go, well, we've got you by the short and curlies and we can do whatever we want with you. And that's a dangerous game. And so when you line these things up, you go, well, there's averaging. Are we doing it because it's the most efficient thing, or are we just doing it because we've always done it that way? The problem is, if you're just doing it because you've always done it that way, then often you're not building real wealth, which means you can never get off the hamster wheel of business. Then structuring, well, you're potentially one accident or one misfortune away from losing everything. And then the banks are controlling you over the other side. Like, you're boxing yourself into 3 corners with kind of 3 institutions that you really don't want to get on the wrong side of. There's a better way. And the problem is, it's the lesser known kind of logic that is being applied in the industry at scale. Some people are doing it really well, and some people have got some great advisors, but many of them have fallen short. And the problem is, you don't know what you don't know until someone comes along and shows you, and then you're like, oh God, there is a better way. And I think that within those 3 areas alone, we see a huge amount of danger for farming businesses.
Thank you. So just to speak to those, taking on a legacy structure that we continue in this generation from the last, what's wrong with that? What can go wrong if we don't review it? And Andy, how do I know if I've got a structure that isn't optimum for me?
It's the hard part, right? But it's not impossible. At your more recent event that we got to present at, we showed what we believe is kind of the optimal structure. So in our other world of the freedom machine and the exit plan, where we deal with all types of business owners, we've got a structure that we believe is pretty much the right thing for everyone to aspire to. It's right for about 90%, maybe 95% of businesses. And we designed one for you guys, and I literally racked my brain and spoke with my counsel around it and tried to double check, because I realized pretty quickly that there's only the most minor difference to the structural change to apply it to farming. And so how do you know if you're in the wrong one? You've got to have some sort of a community, some sort of trusted advisor to really go through it with you and go, hey, look, this is ultimately where we would be aiming at, and this is where you are. Or you've got to level up your education yourself. But I can kind of give you a few tips just straight off the bat. If you're in a partnership, or if you're a sole trader and you have businesses and or, land and assets in those entities, you are limitlessly liable in those entities. And what I mean by that is that if something goes wrong from a tax perspective, from a legal perspective, from an accident on the farm perspective, if anything goes wrong in those structures, you have got no cover other than the potential insurance that you've got. Right now, if any of you have had large insurance claims, you'll know how tricky those things are. And you know that ultimately the insurance companies then go looking for somebody to be able to sue and recoup their losses from. And ultimately, if you're in a partnership or a sole trader, that actually could be you. So they might protect you on one side and then find you liable on the other. So if you're holding one of those structures, I reckon there should be an alarm bell that goes off and goes, hey, I'm taking risk. I don't know what that risk is. Perhaps I should be chatting with, you guys or my counsel in regards to, is this the optimum structure? My view is no. And I'll back it up with a couple of thoughts. The reason why I believe, and this may not be a universal truth, I'm going to offer a lot of opinions here. The reason why I believe partnerships and sole traders exist is for maybe three key reasons. One, it's cheap. Two, it was inherited. Or three, it was just a bad idea. And the bad idea is so you can access this thing called averaging, which all of your listeners will know about. I believe that averaging is not the way to go. I believe it may be for some, right? So there's the caveat. But if you are in a business that you are going to scale and is going to continue to scale and you're looking at taking that to a larger enterprise, if you're looking at doing that, then it's going to fail you. That structure will fail you. And I don't like the ATO setting the rules on how it is that I'm running the game of business. And the problem is when you run the ATO and the banks together, but the whole idea of averaging is that the averaging is set by the ATO's framework, right? So as soon as you start averaging, you don't dictate what happens in the world of tax. It's predetermined by the ATO. Now, you have good years, you have bad years, and it sort of evens out. Sometimes in good years, you will pay less tax, and sometimes in the bad years, you'll pay more tax, right? And that, to me, is just so counterintuitive anyway, but I get why it exists, right? And it's sort of, to a degree, it exists to even out the big years where you've got, significant tax bills. But if you're in the right structure and you can push this tax into a bucket company or an investment company or a service company, and you're using trusts effectively, then you can push those profits in the big years sideways and minimize your tax to 25%. And then in the down years, you can actually distribute profits from those entities to yourself, right? Which means that you're controlling your average over time, not predetermined through the ATO, but you take control of it. And when you do that, there's a couple of things that happen. It unlocks leverage because now you're in the tax system and you're paying tax the way that you should be paying tax. And it is important to pay tax, I think, from a social responsibility. Don't pay too much. I absolutely don't want you paying too much, but we've all got to sort of pay our fair share, even if they don't spend it very wisely. But the second reason that we need to do this is what the key measurement that banks use to give you funding for other things, right? Buying your own principal place of residence, buying an investment property, being able to accumulate wealth off the farm. You need taxable incomes in order to be able to achieve leverage, because if you don't pay any tax, the banks will run away from you faster than the Formula One car can accelerate. You just won't be able to achieve it. And so I call it the averaging trap, right? Averaging means that your tax and your liabilities and you're limited to the government rule or the ATO rule. That then comes out in this idea that we're always trying to pay no tax, which is dumb. And the reason why it's dumb is because if we pay no tax, we can't achieve any leverage or funding. And if we can't achieve any leverage or funding, then we can't release the security, which the banks have, right? And as a result, what happens, especially, and this is a bit unique to agriculture, is the banks will lend you more to trap you into them. So they'll say, keep expanding, keep buying more bigger machines and all of this stuff. Don't worry about whether it's economical for you to do that. Just buy it, because then they've got you absolutely 100%. And so we call it the averaging trap, because it starts with averaging, creates poor funding behaviors and poor tax management. It means the banks get more security than what they should have, and they're pushing you to expand to a degree, irrelevant of whether it's the right thing to do. And I think that in your world, Hutch, what I see you guys doing an exceptional job of is you take your clients through this process of understanding the profitability of the size of the farm, the acreage, what you should be yielding based on that, and help them understand, what is a profitable farm. And I think the addition to that is, what is a profitable farm? How do we minimize tax, but do the right thing and be in the system so that then we can start to de-risk ourselves by getting out of these, handcuffs with the bank, getting out of the handcuffs with the ATO and the averaging, and start to actually control your position. And I think the right time to do that is when you have a good bumper year. You can use that year to restructure yourself, or you're about to have a bumper year. You use that year to restructure yourself, and then you can start to play where the puck is, to use a Gretzky analogy. So don't be a ball follower. Like, if you find the space and you start playing where the game is going to be, then you can control the game and you can do great things. And I think the same thing is true in farming finance.
Great response, Andy. And setting up the structures on the back of that good year for the business that you're growing into, not the one that you've come from.
Yeah. I mean, this happens everywhere, right, Hutch? Like, you're always got this, we're here and we're going there. So what do we need to be? Who do we need to be? What structures do we need in order to achieve that next level? And then should we be doing it as well, right, as you grow?
Yeah. And so, to your point before, we can learn so much from how it's done really well outside of agriculture. And I think to a large degree, as you've described, farming and the business of farming isn't different. What do you describe is the optimal structure? We've been working on this with you and Jace pretty closely. I'm just keen for you to describe it and obviously work through, if you could, the separating of assets from where the risk might come from, and making sure that we've got things set up to be able to manage these institutions and these issues that are coming our way.
Yeah. So this is where the disclaimer comes in, and you got to check with your accountant. Don't take this as personal advice. It won't be relevant for everybody, but we believe that it'll be relevant for most scaling businesses. There it is. It's already predetermined. We believe it'll be suitable for most scaling agricultural businesses. And so the first level is actually having the trading business of farming in a discretionary trust. And what I'd love for people to do is stop using the word family trust, because it's not what's written on the box. Discretion and discretionary trusts, which are effectively they're the same thing. We believe that would be the trading entity for most farms, right? Would be most suitable. And why? Is a really good question, because it's slightly different to what we'd say for normal businesses. And the answer is averaging. So follow this thought pattern. If you have your trading business in a discretionary trust, you have discretion over where the profit goes. So if that goes through to an individual or a partnership, which would then flow through potentially to an individual, you can still access averaging. And I do believe averaging has a place, but I think it's limited. It's not like you don't hit everything with averaging. That's a silly approach to financial management, in my belief. So if you can still access averaging, you can then distribute to all of the family members that are written within the trust deed, right? So it can go to me, my partner, it can go through to my kids to certain amounts, it can go through to other companies and other trusts, right? So the trading business, having that discretion over where the income goes, also gives you the ability to manage your tax. So if you want to play the old game with the new structure, you still can. But then you've got the option of being able to do a lot more with it. So we believe that a discretionary trust is probably the place to trade the farm, but there's a downstream. We then believe that you should build a brick wall between that and then where you hold your assets. And Hutch, you're an asset. I'm an asset. Your team are not. They're liabilities, believe it or not. They may be wonderful people, but they are a risk, right? So we put them over in the trading entity over the side. But we acquire our farming equipment, our machinery, our big assets. We acquire that over the other side of a brick wall, and that may be in another discretionary trust, and it may even be within a company. And this is where the magic happens, because then instead of being a farmer, you are an asset leaser. So you're in the business of leasing assets to the farming activity, and that is another way where you can control the tax, right? Because you're going, okay, well, if you want to use my tractors, if you want to use my machinery, you're going to pay market rate at a profitable rate. And what that does to the farming operation is it makes sure that the farming operation is actually a commercially viable entity in itself, right? So you start thinking about the game a bit differently, and you're paying for the use of your own machinery. And if something goes wrong on the farm's over there, and in theory, that could then disappear, but you've still got all your tractors and you could lease it to other farms. You've still got all of your land because that's held in either in another trust. And with land, we'd have different structures, right? We might have multiple trusts. Sometimes there might be companies, but you hold them in different entities. But that's over the other side of the brick wall, right? And then, so the farm operations has to pay for the machinery at commercial rates. It has to pay for the land at commercial rates, and it forces the farm to be a commercially viable situation. But now your assets are protected. If something goes wrong in farming or in your trading entity, your assets, your land, all protected, right? And that is critical because in business, like statistically, business is like gambling. Like there's a study done in the US, the Australian statistics are not too different. It's actually from Vern Harnish, Scaling Up, which is a great book. 28 million firms every single year. 4% of businesses get over 10 million in revenue. 0.4. I mean, that's a staggeringly low number. And only 4% of businesses get over $1 million in revenue. That includes farming. So for every 100 people who started up a business, only 4 of them got to 1 million. And for every 100, only half a person, for 10 million, only half a person actually got there. And when you think about that, when I sort of intellectualize it and I look, upstream as to why, a lot of the reasons why is because people don't structure themselves right, pay too much tax, pay dumb tax, or fall victim to one of the frenemies. So trading entity is at risk, build a brick wall, have your assets then in different trusts and companies to be able to protect yourself. And then with land, there's no set rule on this, but it might be you might have 4 or 5 parcels in one trust, right? But that might represent 1 million. And then the next 1 million is in a different trust. And you separate out those assets. And when you do that, you're only giving the bank what you want them to have, not access to everything that you have. And this is the way that you can start to control the game rather than have it dictated to you.
Yeah. So with that bit, so separate combinations of titles in separate trusts so that you can retain some of that security back for yourself and not have it all out with the bank.
100%. So if you have a trust, and we see this all the time, if you have a trust and it's got, let's say, 10 titles in there, the bank might say, oh, we're only taking 3 or 4 of the titles. Garbage. They're taking the lot, right? Because there's terms and conditions in those mortgage documents that'll make your toes curl, right? And then when you go to try and deploy those other assets to achieve funding, then it becomes really challenging. But I think that's even too short-term a thinking for me. Let's have a look at longer-term thinking. Like banking makes a big difference. But let's look at succession planning, right? So if at some point in time you want your farm to go down to your children and not all of your children want to stay on the farm, which is really common, right? And because farming is tough, you have to be committed to it. It's like all jobs, or all businesses. They're all tough. Like you got to be committed. And with the acceleration of farmland values, which has been the number 1 performing asset class in property over the last 10 years, by the way, in Australia. And when you look at those accelerating values, you go, well, how do we then think about releasing this without creating tax events to our children? Now, if they're all in one trust, really challenging to do. But if you've got, say, $10 million worth of real estate and 5 is in one trust and 5 is in another trust, and you're splitting it between a couple of children, then that can make the division a lot easier. And it doesn't mean that it cannot be used for farming, but perhaps the children are allowed to leverage off farm some of those farming assets to be able to create their own portfolios. Like it just opens up a world of opportunity. And the challenge is most people think that you can't do it. But the reality is you absolutely 100% can. We've got a client at the moment where we're exploring putting $15 million worth of real estate into the right structure. And because their aggregated turnover is under 2 million just, we can do that 100% tax-free and pay zero stamp duty in the transition of it. So it's absolutely possible to get it into the right entities. And we kind of go, well, if you're scaling and you've got, 10, 15, $20 million worth of land assets, that's a lot to leave at risk. Like, there's a better way.
Andy, if we just look outside of agriculture to normalize this for a moment, and I feel like I get on my soapbox on this often, but I'm so pleased we're having this conversation. If we think about an accounting firm or a financial planning firm or a vet practice or a physiotherapy practice, they've got a trading entity and there might be 1 or 3 or 5 shareholders, all with different shareholdings in that trading entity. And then most of them rent premises from a landlord somewhere, and there's a commercial lease charge. And to your point, the business that the shareholders have an interest in has to profit after paying a rent to the landowner.
Yes.
For a manufacturing company or an industrial company, they have exactly the same construct, except they're renting a shed or a warehouse, and they'll have a separate entity for their trucks and their equipment. And to your point, there's a rental charge on the plant and the infrastructure and the equipment back to the trading entity. I guess it is common practice outside of agriculture. Do you have a view as to why that construct isn't more normal practice in agriculture, where it is such a common method by which to do business in the small business land?
Oh, you might make me a hated man in a moment. I've got an opinion on it. I couldn't irrefutably say I know. My belief, and it's through experience, it's not just a random thought. Firstly is the professionals that surround people in agriculture. And quite often it's mum and dad's accountant, mum and dad's advisor. Why? Because they were the ones who always did it. And like I said, and we say this to all businesses, right? You will outgrow your accountant. You will outgrow your mortgage broker. You will outgrow your advisor. You will. If you are a growing business and you're scaling and you're getting better and better and better, you will outgrow those people who are not growing at the same rate. That's just the way that it is, right? You don't keep your grade 2 teacher when you finish grade 2. You go on, you have a new teacher in grade 3 and a new teacher in grade 4 and so on and so, because you've got a different curriculum that you need to learn. Exactly the same thing is true of a scaling business. It's not the same problems that you fight. And this is like, for anybody in business, might deter some people, but it's like, you never stop learning in business. Like, business is a thing you will never master. You'll never even come close. But you will keep leveling up to new levels, and you need to become a different person, and you need the level of professionals to do that. So I believe that that's one, is that the advice is the advice, and it's always been that way. And when you have those relationships, like, and Hutch, this is for real, I said more recently, client, I said, so why are you trading, why is the land and you're trading in a partnership? And their response was, it was the cheapest vehicle. And I said, did you want the cheapest vehicle? And they're like, well, we don't really know what we want. I'm like, well, let me just put it into context. It's $6 million worth of real estate and a $4 million sort of trading business that were in the same entity for $1,500 to maybe $2,500 to protect that. Is that, and they're like, that's ridiculously cheap. I'm like, yeah, but the view of the accountant was, you want cheap. And it's like, hang on, and again, I think this is dumb thinking, because it's like, we're dealing with millions of dollars here. And the idea of putting it in the right structure costing $2,500 is just insane. So I don't believe that they're bad people by any stretch of the imagination, but I believe that they're playing the game. And if you're looking, they're playing the game based on their vision of the world. Now, if their vision of the world, and accountants are quite often quite conservative people as well, and they're designed like that. They look backwards to see what happened in the past to figure out what's going to happen today. Would you be taking forward-looking advice from somebody who's always looking in the rearview mirror? And if you are, it's dangerous. Like, imagine driving a car only looking in the rearview mirror. Are you getting where you're going? Like, if you do, it's by incredible braille driving skills. But and the reality is you're not. So you've got the accountant trying to do the best that they're doing with their lens of the world. You've got the farm owners looking to them for business advice sometimes. It's like, no, they're accountants. They're not there to give you business advice. So I think that's the second sort of reason that they're in the wrong structures. And the third reason's mostly, I think most of them think that there's just not a way of being able to do it. They go, oh, well, it'd be great to be in the right structure, but we're going to pay all of this capital gains tax and all of these things. And the reality is sometimes you can't avoid that. And when I say you can't avoid it, you'll never be able to avoid it, because when you die, the tax will be due and it will be the kids that inherit it. So it's a choice as to whether you do it when you're alive or whether you leave it to the kids to manage, if you're in the wrong structure, or you get the right advice. And like I said, you can get, $15-20 million sometimes into the right structures. And also you can isolate your partnerships. If they're trading and they hold land, you can pull the trading business out and leave the land in the partnership. And to a degree, that protects it a little bit, and get the trading structure out of the partnership and into a trust whereby you can start to deal with what we call an ideal structure.
Yeah, thank you. And I guess there are certainly some accountants in our industry who are proactive around this and doing a good job. So I certainly appreciate you talking around what you're saying, but I sort of want to make sure that we do acknowledge the good work that many do.
Oh, heaps. But they're rare as well. They're like unicorns. But a business owner's job is to try and find a few unicorns to go and hang out with.
Yeah.
And most of the stuff that I've learned, especially in this space, is from some very, very good accountants, of which you work with, as well, because they're absolutely 100% needed.
So just practically, if I've got my business structure separate from my land assets and other assets, key assets, and there should be an accident of significance on the farm, or there's a significant claim from a team member, or there's another one-off shock, or if we have a couple of tough years and the business is deemed to be insolvent or unviable, if we've created the structure that you've talked about, we can wrap up that trading entity, re-establish a new one, and keep our land assets and our infrastructure and our equipment separate from any risk of claim or accident. Is that right?
It's not just through the structuring, but yes, you can achieve that. There's a few other rules that you need to follow, but yes, the whole idea of doing this kind of structuring, and it's been done for years, is to be able to protect those things that are real assets and protect them from the harm of a trading activity. And as long as you manage things called your personal guarantees, right, which are critical, you follow the rule book of how you lodge your business returns, right? And the ATO are getting more and more red hot on all of this stuff more recently. And I'll give you an example of how you can come unstuck. So you might have assets personally, right? Because they may still be in your name or in a partnership, which effectively means it's personal. And you may have an event on the farm whereby in the operations, the trading operations of the farm, and it's not overly profitable, and you've got no cash. And you then decide, okay, well, let's not lodge our BAS, right? Because if we don't lodge the BAS, we don't have a debt, and we then don't have to pay it. We're eventually going to have to pay it, but we can buy ourselves some time. It seems like a logical thought pattern. Use the ATO as funding. The idea of doing that makes logical sense, but most people don't understand that if you do not lodge your BAS on time, you will get this thing called a director's penalty notice. And a director's penalty notice can then mean that the liabilities that are incurred as a part of you being a director of the business can then be personally for your personal assets, right? So one of the rules that we teach is always lodge on time, always lodge on time. Now, whether you pay it on time or not, that's a different story, but you must lodge it on time, because if you don't pay it, you'll end up with the ATO saying, okay, here's a payment plan or here's interest on top of that, and no problem. It's the lodging part. If you don't lodge it on time, you lodge it late, then that can turn into a director's penalty notice, and that means you're personally liable. So the structure itself is not enough. It will help you infinitely more, because if you had the farmland in that same entity and it became insolvent, that's a disaster scenario.
Thank you. Great comment. So we've got to conduct ourselves professionally at the same time. The other thing I like about this structure is I think it does a lot to solve succession. And you mentioned that earlier. Like if we think back to that vet practice or that accounting firm, they're always doing succession. Is that often there's a senior partner in one of those firms that's selling down equity in the business at a commercial rate to the younger generation of vets or financial planners or lawyers or accountants coming through. And it's actually the model around which a lot of these professional service firms have grown over time, is giving equity or the opportunity to buy equity to the next generation coming through. I think that if a son or a daughter comes back to the farm and builds out their career to a certain level of competence, that in their mid-30s or late 30s or whenever it is, they can be given the opportunity not to be gifted a parcel of land or to be gifted some shares or to become a director of something. They could be given the right to buy equity in the business at a commercial rate. They might get vendor financed into that by the older generation. But it just happens so often that way. And what that facilitates on the flip side is some retirement and succession planning for the older generation that are incrementally selling down their shares to the next generation. And all of that's around the trading entity, separate from the land ownership entity. In the same way, it's just the business and it's the landlord in a professional service type setting. Would you mind speaking to that? And do you see this model actually being able to make positive gains around farm succession?
100%. And that's kind of what we do as a consultancy is help businesses understand the succession in the non-agri world as to how to exit their business, because the reality is it's going to happen, right? It's either death, disablement, or a bad situation, and that's business transitioning either into not existing or to family members. So the idea is get in front and do it early. But you kind of hit the nail on the head on a few different areas. And this is where all of these key things that we've already spoken about, kind of they're symbiotic, they all work together. If you have the trading entity is properly profitable. What does properly profitable mean? It means that it's paying commercial rent, it's paying commercial rates for the machinery that it's using, and then it's paying the wages of the people who are running it, right? And the wages of the people who they're employing to run it, and then still has something left over, right? And if we take that and we use it and we get that into the tax world, right, and we control the game and we are paying tax along the way, then that unlocks funding. That's super important because it's the unlocking of funding that then unlocks the succession planning. And what you said is 100% right. If you have these structures and you have different land assets in different entities, then you can use those things in different ways. And we've been helping somebody out recently whereby they actually decided not to do it. And there was a parcel of land that they had which they could repurpose, and they were going to use that with two of the boys. And the rules of the game were, well, we're going to sort of kind of vendor finance you into this, but everything's on a commercial basis, right? So we're the bank of mum and dad, but we're the proper bank of mum and dad. You don't get it for free. You get it on commercial terms because we could use that in our own business and produce a profit of X and Y. So we're going to help you out. But because that was separated, they could take that legal title and align that with a very separate business without risking all of their other assets. And they could create a training ground to basically train their children on how to create commercial farming from scratch, which is highly subsidized, but while not risking all of the other assets. So as a training ground, when you separate assets like that, unbelievable from that perspective, because you can protect yourself and you can allow them to take risks and allow them to make mistakes, which is the game of business. Then, like we touched on earlier, you can then separate some of those farming assets out or the land assets as a part of the greater succession plan. And in so doing, you can say, well, these parcels of land are going to be left to the children who are not going to be a part of the farming operations. And you can put some terms and conditions, or you can say that they're to be sold. And the farming operation needs to descale at that point in time in order to be able to fit the land that is left.
Or have the
And
right to buy it at a commercial rate
commercial rate.
or an agreed nominal discount because it's an in-family purchase of some description, but at least it's agreed early so that the
Yes.
non-farming children have some certainty around what succession can look like for them.
But if you're not bankable because you're not showing the right amount in the tax returns, the best way to do what you just suggested is to get a bank to fund it rather than vendor finance. Because if I'm Andy Fenton's son not on farm and I'm like, oh, well, there's $10 million worth of property, but I can only get an interest rate on that of 5%, and that's the money that I can touch, I'm not going to be too happy. I'm going to be sitting there going, hang on, it's a bit not fair for me. I should be able to utilize the capital. And that's a way that using the bank funding model, you can actually do that. And you've got a greater capacity to be able to do those things if you're showing the right amount of profitability, the right amount of tax. And so this sort of sequencing of averaging, structure, leverage is so critically important because it unlocks, the things that ultimately everyone wants unlocked, which is the ability to be able to hopefully, have freedom from the business, to be able to transition the business to their children if the children want it to be, and ultimately for it to be able to provide the life that they've worked very, very hard to be able to achieve and not have it taken away because you made a mistake.
Yeah. Thank you, Andy. And I think for me, we talk about succession being the transition of management responsibility, transition of business, and then transition of land. And I think this structure separates those really cleanly. You can hand over management responsibility and then you can hand over equity in the business at a commercial rate and achieve that separately to transition of the land asset to
Yes.
on and off farm children. And so I think it really does sort of achieve that nicely. And for me, it breeds out the construct of entitlement too, where the younger generation, like that junior accountant, whether they're family or not, they've got to come into the accounting firm and work their way up and perform. And then only some are given the right to buy equity in the business. But once they do, then they get on and treat it like their own, which I think is a really healthy way to bring that next generation into business.
Absolutely. Like one of the stories I love to tell is Malcolm Palmer, who is an investment advisor that we use with, and I've known Malcolm for many, many years. He's part of Joseph Palmer and Sons, and his family business has been around since the gold rush days. His great-great-grandfather founded the Sydney Stock Exchange, and so the business is effectively an investment management business. But Malcolm didn't finish school and finish his commerce and degree and then jump straight into investment management. That's not what happened. He had to go out and get a pedigree, and I've forgotten who it was, but it was sort of like a Goldman Sachs of the world, and had to become an investment manager with some of these larger companies to understand and to learn the skills to be able to then be able to take on the responsibility of a multi-generational business. And, when I think about it, when I've seen this done really well in the non-farming world, it's when they have effectively allowed the children to go out and learn the skills externally so that they've kind of made it in their own environment, or created an environment in which they can step into where they can fail, but it's not catastrophic for the other parts of, the family business. And so it allows them to earn the right, and they'll be better as a result of it.
Yeah. Thanks, Andy. So then what about the off-farm investment piece? I know you advocate for farming families to have the right structure and the discipline to be investing off-farm for the purpose of sort of diversification and wealth creation early. Would you mind just speaking to the optimum structure for that?
It's a little bit different to, and I don't want to use the word different to other businesses because I believe that's almost a cop-out. The difference is the land value, right, for most of the pre-existing farms. Maybe I'll tell a story and then I'll link back. There's somebody that we're working with right now, and they've got about, I think, $11 or $12 million worth of land. right, which was passed down from mum and dad, a successful succession plan. And they're starting to look at their journey. And we met with them and I sort of said, look, you've got this $12 million worth of real estate. I said, how profitable is your farming operation? Right? Per $1 million worth of land owned, how much do you make? Right? The number was X, right? And that doesn't sound to me like it's a profitable, sustainable business. And I said, you've got a bit of work to do with the farm owners. And then he said, yep. And he said, we know where we're going. Like, this is where we're going to go. We know how many years it's going to take us to get our profit potential up to X and Y. I'm like, brilliant. Okay. So let's deal with how much stress you're facing right now. And he's had some challenges, income challenges and those things while he's getting the right infrastructure in place and doing all of the right things as all business owners do. I said, well, how's about if you just totally de-risked your personal scenario for the remainder of your life? Right, let's just take it off the table. Let's just do one maneuver that totally de-risks you for the remainder of your life. Would that remove the stress? Like, yep, 100%. All right, cool, because stress is a killer. So the strategy was really simple. It was, well, let's liquidate 2 million of that 10 million in assets, right? Find the parcels that are the most suitable to liquidate because you're not running the farm at the moment at its peak performance. Have a chat with you guys to make sure that doesn't interfere on the plan and that growth trajectory. But if we actually separate that out and you can put that into super, $1 million into super, tax-free, boom, that's the remainder of your life taken care of. Like, you never have to worry about super, that'll take care of you, right? Then the second part was, well, let's take that other $1 million and let's invest that off farm. And then that can generate, worst case scenario, it'll give you $50,000 a year. Or you can eat into the capital in really bad years. You don't have to stress so much, but we can invest that and we can do all sorts of weird things there and wonderful things. But over a 40-year period or a 20-year period, like, that will grow exponentially and their lives are taken care of. And the average share market return, just to throw some numbers out here, is around about 8 to 9%, depending on which cycle you're in. And so the idea is that, well, once your farm operations is highly efficient and highly profitable per acre or per land that you've got, then you can lease that land back. Because what do you lease land for? It's like 3.5% or something like that was a number. Well, it's like, well, then you can use your investments to refund and fund the lease for you to reacquire that land to farm it, and then you can eventually acquire it again. So this idea of growth at all costs, or I must have as much land as I need, as I want, I think it's a false economy. You got to build your business to be profitable, and the amount of land that you need to be able to maximize the profitability of what it is that you do based on the assets that you have, and then you scale that. And if you've got too much land based on your profitability and productivity, then you're better off to actually liquidate some of that and then use the investment returns to then repurchase it once you've got up to profitability. But it all comes down to profit.
Yeah, it's a great comment. The profit that we're helping our members pursue is in the order of 25 to 30% of income after paying commercial wages and interest.
And that's the same of almost every other business, right? Some are 5 or 10 higher or lower, and some of the larger scaled businesses sometimes get lower, but that's kind of the general mark. And so the idea is to be able to structure yourself up, and we've got a few key moments going back to the wealth part. You can earn up to $200,000 personally in taxable income, and you can utilize strategies to reduce your tax payable to 5% by using the right types of investment strategies. So if you're young and you're accumulating and you're shooting for the stars, you can take that money, pay tax on it, get deductions on that, and then end up with assets and incredible funding capability from the bank. So that's number one. You should always have, and you should aim, in my view, you should aim to have $1 million per person worth of assets outside of superannuation that, unless you're willing to sell it, it's not a real wealth asset. So if you've got $40 million worth of farmland, you are not wealthy. If that's used for the business, it's business asset. It's not wealth asset. You're kidding yourself. If you don't sell it, it's not wealth. Or if you can't take a chunk of it and fund your lifestyle. The second one is that each person, based on the current rules, can have $2 million sitting in superannuation and have that tax-free for the remainder of their life once they're 60 and retired or 65 years of age. And so those are the key kind of structural things that we look for. And you go, okay, what's your strategy to get to 2 million in assets in super? And what's your strategy to get to at least $1 million outside? And you can utilize the profitability of farming to do that, like every other business can, if they structure and they are a profitable business and you are paying yourself first, right? And you have a real business, and a real business is where you pay yourself first and it is genuinely profitable, then creating these assets outside of farming just provides, well, it makes sense. It provides you freedom, and it gives you the ability that if something really bad happens, you can pull the plug. You can step off the hamster wheel and go, we're fine. Things are going to be totally fine because our assets that our operations have bought us over time can now sustain us into the future.
Yeah,
And what we find
and
is when
the other thing
people
about it is that it can accumulate over time to be part of the succession formula for non-farm children.
absolutely,
Yeah.
absolutely, absolutely.
Thanks, Andy. I've just got one more theme or one more question to explore, if that's okay. We talk about having your dream team around you of key advisors. Who do you think they need to be is the first question. And secondly, is how do we make sure that they're the right people for us to underpin where we're off to?
Right people is a little bit more challenging, how to know they're the right people. But in our world, we call them the core four, which is your mortgage broker, your accountant, and your financial advisor. And then legal counsel is number four. And legal is for conveyancing, for asset protection. You'll interchange that person. But you need those four roles in your life. Now, I understand you've got the dream team and you've got an additional one there that is very farming specific. But every business owner needs a good accountant, a good advisor, and a good mortgage broker. Potentially in farming, you need a good mortgage broker for off-farm assets and a good mortgage broker for on-farm assets. The reason that's separate is because a mortgage broker who specializes in getting you investment properties or commercial properties that are non-farm related is quite a different role to the ones that finance farmland for farming operations. So they may be, under the same banner, but two very different people. So accountant, mortgage broker, financial advisor, and you will need legal counsel. But the three of them should play well together. We say they've got to learn to play well in the sandpit. And to quote Herb, who was the head hockey coach of the NHL team in America, I love ice hockey. And they had the professionals striking, and it was at Lake Placid during the Cold War, and the professional players went on strike because they wanted to be paid for the Olympics. And so the association said, no, get lost. And they had a trial of college students, college kids. And Herb, after one day of trialing, was quoted as saying, here's the team. This is who we want. And the others went through and they said, Herb, you don't even have some of the best players. And he said, I'm not looking for the best players. I'm looking for the best team. And without having the best players, he created the best team and he beat the Russians for the first time in history by having the right team, not a superstar team, but the right team involved. So the question is, how do you find the right team? And I believe, number one, you find people who are collaborative, not individuals. If they think that they're a rock star, I've never met anybody who's the custodian of every great idea. The combined mind will find much more in the way of benefit for you as a client than any single mind will. The second part is that they should be open to being critiqued and potentially red teamed. And red team is a concept where it's a little bit soft, but you're going, Hutch, I just want to red team that. I'm not 100% sure that that's accurate, right? And the red teaming is critical because, again, we're going to make mistakes. And you want to have your team covering for you. You want to make sure that if the advisor drops the ball, the accountant catches it and vice versa. And so to a degree, your accountant and your advisor are almost like accountability buddies to make sure that the strategy is always working best in your favor. And finally, and this is probably the most critical part, and I've got some content out there called How to Interview an Accountant. I couldn't even tell you if you Googled it, whether it'd still come up. It was a long time ago where I did that. But the essence was this. You don't know what a good accountant looks like unless you're an accountant, but you're a great farmer. So you go, okay, well, as a farmer, what would I see, hear, or feel that would tell me that my relationship with my accountant is a success. And just think about it. You might go, well, I'd be meeting with them on a quarterly basis, maybe 4 times a year. We'd be doing real tax planning, so we understand our tax. We'd be red teaming our structures. I don't know, whatever it is for you, you write out your list. And typically it ends up being anywhere between 10 and 20 things. You write that list out, then you re-interview your own accountant and you pick another 3 or 4 people to interview. And it goes like this. Hey, Mr. or Mrs. Accountant, my name's Andy Fenton. I run a cattle business. We've got $15 million worth of land. Our annual turnover is, $5 million. We're expanding. We want to acquire more land. We want to aim for a profitability of X and Y. That's a little bit about us. How do you service businesses just like ours? And then you shut up and you listen. And you grab your tick list, right? And you just start looking at it. How many of those things is the accountant actually ticking off? Right? And if they're ticking off none of them, you're probably in the wrong spot and move on to the next person. If they're ticking off your list, then you're going to start to hear very specifically how they operate. And so they might say, well, look, every year we'll have a quick review of your structures to make sure that you're in the most optimum structure. We'll understand what you're doing off farm. Are you creating wealth off farm? Where's your superannuation at? We need to collaborate with an advisor to make sure that you're ticking these boxes. And so they'll start speaking in a language, because when an accountant, an advisor is actually a specialist at dealing with you, they'll be able to tell you what the relationship looks like. And if they're ticking your boxes as well as sharing some other ideas that you would like, then the chances are you're in the right place. Play well in the sandpit, ability to be red teamed, and then interview a few others. And over time, I think you should always get a second opinion. And, with your dream team and the sort of the family office that we're putting together for the farm owners, that's the capacity for people to go and speak with a team of professionals who are non-biased. They're not paid by the client. So we can kind of go, well, we think that you should ask these questions and there's a better way of doing it. And we think that this is it. And you can take that back to your advisors. And if your advisor doesn't like being red teamed, then maybe that's a sign that the relationship needs to change form.
Great comments, Andy. As I mentioned, mate, it's been great to have you be part of our most recent conference. But on behalf of the FOA directors, we've really enjoyed tracking over the last few years with you and Jace. And we're delighted by this optimal structure that we're kind of coming up with to support our members. And we're really grateful for the way that you're turning up, pioneer that with us. It's unreal. Have you got one final reflection or tip that you'd share to that, perhaps that young farmer, husband and wife team coming through to make sure that they are really proactive around this?
Around the structuring, look, I think there's probably 2 things. You've always got to listen to the wisdom of those that have been there before you, because there's wisdom that will be invaluable. The hardest job, I think, for children coming on is to come on board with a sense of being humble about their knowledge and humble about the relationship with your parents when it comes to succession planning. Because if you're too arrogant, you miss all the wisdom. And if you just take all of the wisdom and don't question it, then you're probably going to end up in the wrong structure. So there's, humble and questioning with humility, I think is probably a good tip. And that's just every intergenerational business, because when we're young, we're full of ideas and that should be cultivated, not crushed. But some of the reasons that things are done the way that they are, they should never be changed because they're actually good. And you want to make sure that you don't throw the baby out with the bathwater of the new ideas. And I think the second part is really farming is a business, and the business is there to support you as an individual and to support your family and your children. And if you want to set a good example to your children, of which I'm trying to figure out how to be a good example to my son now, and it's extraordinarily challenging. Who do I need to be the best person for him is a question I constantly ask myself. And in business, one of the things that I'm trying to focus on personally, as well as trying to cultivate for other people, is going, well, allow business to be this incredible tool of freedom. And ask yourself the question, well, how do I generate freedom? How do I truly become free of my business so that then it's a choice to be in the business? And then business can become a lot more fun when it's a total choice. Bad year, It's a choice. We're still fine. We're good. Great year, amazing. We're good. We're great. We've always got a plan, but always aim for freedom, because ultimately, and this happens in all business, in all walks of life, if you don't, then there's a reasonable chance that you will build a job for yourself that you cannot get out of for the remainder of your life. And that can be soul destroying, and it can be crushing, because then a bad year can really do some damage. And if you want to keep yourself safe and provide an incredible life for your family and teach them how to enjoy the game of business, shoot for freedom and try and sort for that as your number one in your business journey.
Thanks, Andy. Really appreciate your time, mate, and really appreciate your comments.
You got it, mate. Like, I think I've said it to you guys before. I think what you're doing in the sector, you're going to change the way that agriculture works in Australia. And I think that you should all be very, very proud of what you've created so far. And I know that you're going to do an incredible job of it moving forward. And those that listen to the podcast and those that work with you, they should be very, very grateful, because if they don't know how good you guys are, well, hopefully they'll get to learn. You're making a difference.
Appreciate you saying that, mate. And it's only for the quality people that we have around us, like you and Jason, Jeff and Terry and so many others that we call on to help us do what we do. So thank you so much for your time.
Welcome, mate. Great to be here.
And there you have it, team. A really compelling conversation with Andy. Thank you, Andy, for your time and your insights. I think this is a really important topic. We've got to make sure that the structures that we have are setting us up to achieve the sort of wealth and the sort of succession outcome, the sort of management transition, and the success that we need into the future. Some compelling insights there. I'll let you reflect on what we've just covered, but encourage you to think deeply about who you have in your dream team around you. Make sure that your advisors are the right people to help you lead your business forward, and that they are collaborative and open-minded, and that they're challenging you to make sure that your strategy and your structures are as sound as they can be. Thanks, everyone. I hope you found that useful. Thanks, Andy, and speak soon. Bye for now. Thanks for listening to another episode of the Profitable Farmer podcast by Farm Owners Academy. If you're new to this show, be sure to follow us. If you've been a long-time listener, let your friends know about us, or come continue the conversation in the Profitable Farmer Facebook group. All the best as you grow your business and create your freedom farm. Until next time, keep being incredible.